Pence, and it's the afternoon of June the 3rd, 2021. This is a kind of a brief rundown of what's going on now. Today I'm going to talk briefly about the markets, the economy, taxes, inflation, and the Fed, and then, as always, the so what. What does all of this mean? Well, we're talking about markets right now. It's kind of interesting, the volatility that's going on in the markets, kind of where are we? As a matter of fact, here at the team, we kind of put together every year what we call the range fan, where we calculate out the earnings probability of the S&P 500, kind of put that on a graph and kind of watch it throughout the year. So you can see this year kind of where we stand. So we get a little above the top range of the probabilities. Obviously, the market pulls back, and then you can kind of see the volatility around it. So as we look at this, we recognize about midway through the year, we're kind of near the top end of where we think the market might be based on earnings and projections for the S&P 500. Now, this is a series of the S&P 500 put out over time for the last several years. And there's a couple of really interesting things to notice about this. If you look like in April somewhere of every year for most of these years, not all of them, you can see the big ugly part from the coronavirus last year, you notice there's been about a 4% pullback in the market, and that's because people get liquid in April of every year to pay their taxes, right? So what happens is people sell out their portfolios a little bit, they've got to get some cash, they pay the taxes, and the next thing they do is kind of move on through the year. Well, in this year, tax day was in May, and you can see how that kind of period of time, that sell-off kind of moved into May, you can see, and now you can see if you look at this year, which is the top line, how the market's kind of bumping its head, right? It can't kind of push through to the top. And the reason why we think that's going on is you have further tax effects. If you remember last year, because of COVID, you can take a look at that. The market went way down in March, and then it got fully recovered back in August. So what's going on now, we think, is that you have some selling pressure at the top end of the market because somebody who got in last year kind of rode it back up has now reached 1 year after their purchase price. So they're beginning to sell their positions to take advantage of long-term capital gains. They figure that capital gains taxes may be cheaper this year than they have been any time in the future. Or anytime in the future for the next couple of years. So the big thing to look at is we've got some selling pressure at the top of the market, and we think that that's going to continue probably through August. So you kind of have a top range in there that we think is coming in. In the meantime, earnings have been fabulous. Most of the companies, 497 out of 500 have reported. Most of them are beating on sales. Most of them are beating on earnings. You can look at each of the segments and sectors. So the market is doing pretty well. The companies are doing pretty well. And this is what I'm calling is an improvement in price quality. While the prices are not going up quite as much as they have in the past, we have this kind of top effect to it because of taxes and other things like that. The market's a little toppy. Earnings underneath are getting better and better and better. So that means the quality of those prices are getting better. So in the end, remember, it's all about fundamentals. It's all about earnings. And as this chart's telling you, the earnings are looking pretty darn good as we come out of the pandemic and move forward into growth. Now, this is also showing up in repurchase authorizations from corporations. You see, if you're a corporate chief financial officer, your job is to maximize the value of the capital you have on your books. And what we're seeing here is increased corporate buybacks. And the reason why is, guys are looking at the price of their stock, they're looking at what they know about their company, and they're going, boy, the best place for me to put capital is to buy back my own stock. And so you're seeing a bit of that take place. So these are the kind of the forces that are moving the market right now. So for the market, we expect to see some continued volatility through August, right? We always say you want to take advantage of volatility, not be its victim. So you want to always have some dry powder in your portfolios. You get these headline-driven dislocations in the market. You can kind of take advantage of those things. We think we're going to continue to see this kind of top cap on the market due to taxes and concern about what's going on. Run through August, we're going to see earnings improve and continue to improve, and that's going to improve the quality of the pricing. So we're going to kind of see this volatility through August, we think, and then we're going to see what goes on at the end of the year. Let's move on and talk about the economy. Now, this is a slide that I've been having up here for quite a while. It's really a tale of two halves. First half of the year, and we're almost over with that, is really about government stimulus. We poured a tremendous amount of stimulus into this economy last year. I mean, they put $5.4 trillion of stimulus into the economy. That was, in 1 year, we put in more stimulus than we did all of World War II, all the cost of World War II. So this $5.4 trillion has kind of come into the market. It's stimulating the economy. You're seeing some pressures there, but you're seeing the economy move forward. And so in the second half of the year, we think the driver is going to be pent-up consumer demand funded by tax savings. Everything's opening up, people going out again, and a lot of people have a lot of cash. And so that's what's kind of driving the second half of the year. And then as we get into 2022, the things we have to pay attention to is you've still got this government stimulus, and then you're going to start seeing taxes kind of compete with that. So that's going to be an interesting thing to watch next year. But I want to illustrate for you this issue about a lot of people having a lot of money. Now, COVID affected a lot of people, particularly in the hospitality sector. And some people in some small businesses were absolutely devastated by this. On the other side of that, there were a whole lot of people that weren't as negatively affected. And what's happened is we've got about $1.5 trillion worth of excess savings now. People got a lot of cash, they just put it in the bank. They really have about 3 years of excess GDP growth in this excess cash that's sitting around. So when you think about that, people have a lot of money. And that money is shown up on their balance sheet. Household net worth is one of the highest it's been in a long time. So in this backdrop of what's driving the economy in the second half of the year is consumers wanting to get out and consume and having the liquidity and the money to do it. So we think that's going to continue to be a driver throughout the rest of this year. Now let's talk about what the effects that has on taxes, inflation, and the Fed. That's the thing everybody's going to be talking about. So let's talk about kind of separating out the myth from the reality and some of these headlines you're going to be seeing in the media. When we think about taxes, inflation, and the Fed, the first one, let's talk about taxes. I mentioned that a little bit before, but there's this proposed very significant tax hike in capital gains. And right now the proposal is it kind of goes back into April sometime, and it'd be retroactive. We don't know how that's going to happen. But if you look at history, times when you've seen these large increases in capital gains taxes, they last for a while and then they go down, right? So it doesn't stay there forever. So one of the things you have to think about is that we don't know whether they're going to get the retroactivity on this proposal. But one thing to think about is if you think you need to do some sales this year, it probably makes some sense. Go ahead and do so. Pay the capital gains tax in this year, because capital gains taxes this year are either going to be as high or lower than what they're going to be for the next 3 or 4 years. Now, when you get beyond that, it's a reasonable expectation that capital gains taxes may be coming back down in the future if you look at history. What does history tell us here is that when capital gains tax get really high, after 2 or 3 years, you have an election, and then they go back down. So these are some considerations that you have to have as you look for it. The other thing that is important is everybody right now, it's kind of silly season with numbers, right? Everybody's talking about, well, we're up this much, or we're down this much, and all of these numbers are being thrown at you in headlines in the news, but you have to remember this idea about base effects. And what we mean by that is people are kind of choosing a point and place in time for their numbers and their illustrations that are off a really low base. I mean, you could go back to the bottom of the market in March a year ago, and then you look forward to this year, and my gosh, you could be up a significant amount of money. I think some prices have doubled and even more. So it really makes a difference when you get some points of reference, and that's what I want to try to share with you. If you think about this, if we think about GDP quarter-over-quarter annualized growth, you can see the big dip. It was going around pretty normal, pretty good, and then you can see, boom, we hit this huge dip in last year as COVID hit and everything shut down, and then you had this rapid rise back off as we've covered, and now it's kind of come back down and leveling off. This is just all the math of this, and so don't get overly carried away by whatever the latest headline is, right? The things that I think that are important to pay attention to are there's really 2 prices that affect human behavior. You know, the price of gasoline and interest rate. You know what you pay for gas, and you know what the interest rate on your mortgage is. You probably don't remember what you paid for peanut butter. And most of Americans are like that. So the prices that really affect the consumer and really affect how people spend and do things, we always try to spend a lot of time looking at gasoline prices and interest rates. So let's pay attention to that just a little bit. You can see how some of these numbers kind of are overemphasized in the press. So as we look at it here, we want to take a look at what's the daily national average for a gallon of gasoline. We can see it's gone back up from a very low base. We can remember when prices were fairly low, right around $2 or so for the average in the country. And now you've gone up significantly. In many cases, you're up $1 more, you're up towards $3. And that's significant. It's a big, big difference. But it's also not necessarily that much higher than when we were at the beginning of the pandemic. So you can say, oh my gosh, gas prices have gone up by a third, or in some places they doubled. Well, at the beginning of the pandemic, they're not that much different. So you can see all these illustrations that people are throwing out there, and they're skewing them in the news. Now, here's another one that you'll find interesting, and it's really very important. And that is used car and truck prices. Okay, there's been, because of supply chain disruption, there's been kind of a shortage of new cars, right? It's difficult to get new cars in. So what's happening is people that they're seeing prices go up for used cars and trucks. Well, as you think about that, you can see this rapid rise in the inflation rate, or the price increases for used cars and trucks, and that's because there's actually a supply chain constraint shortage of new cars. And I talked about supply chain constraint inflation in the last video. You can go back and watch that, where we gave an illustration of that. But here's kind of, it's showing up in the real economy now. But what happens when we talk about data being given out and what the people in the news are talking to you about? Here's an interesting fact. They talk about consumer price inflation. Oh my gosh, we're having a lot of pricing, consumer price index going up, and it's 3%, and everybody's overreacting to that my price is going to go through a tremendous amount of inflation. But did you know that if you just pulled out the used cars and trucks from that data feed, you ended up with a 2.3% inflation rate, not a 3% inflation rate? That's a very big difference. Very big, just by adjusting for one particular variable. So you can see some of these headlines overstate particular aspects. The other thing is you have to take a look at the Fed. Everybody said, oh my gosh, inflation's coming and the Fed's going to raise interest rates. Not so fast. When you think about it, the reason why inflation matters at these levels is because it matters what the Fed does with interest rates. But the Federal Reserve has been telling everybody, we're really not going to be raising interest rates for a while. We are going to keep them low. We want inflation. They want inflation. And they've been having a hard time getting inflation above 2% for the last 11 years. They've only gotten there twice. So I think when you think about all this inflation numbers that they're talking about, you have to recognize the Fed wants inflation. They're having trouble getting it. That means they're not going to be in a hurry to raise interest rates. They're probably going to continue to keep them low. And indeed, the economy could stand a 3% inflation rate for about 5 years before the Fed ever reaches their target, right? Because they're now let's look at an average over time. So it's very important to recognize when people are talking about panicking about the Fed raising interest rates dramatically in the future, I think that that's probably a little bit overdone. But let's talk about how this shows up in the real economy as well. Now, I'm going to go take you back to a moment in about 2017, 2018. Why are interest rates important? Well, interest rates are important because it's a big ticket item for people, and it affects the decision-making process of people wanting to buy new homes, new or existing homes. And there's a thing in human behavior kind of called the price elasticity of demand. And what that means is at a certain price, people's behavior change. They just go, I'm not paying that for that product. They're sensitive to it, but it's not a straight line. You reach a point where it's just that's just too much. So if you think of housing prices, and we go back to 2017, 2018, you can see very carefully here, when the home mortgage interest rates tick above 4%, demand really goes down very, very rapidly. So we can think about, as you look at housing and everything out there, and you think of interest rates going back up, you're going to see major changes in the demand for housing when we see mortgage rates kind of tick above or get close to that 4% number. So kind of watch out for that. These are the things you should be paying attention to. Now, let's talk about employment, right? A lot of people want to talk about how many people are unemployed. I like to talk about how many people are employed, right? They're making money and they're putting money into the economy. We're rapidly getting back to where we were at the end of the Obama administration. We're rapidly recovering, as you can see in this chart. And I think what we're going to probably see is that by the time we get to September or October, the employment situation will have really kind of come roaring back, because there's still a lot of people that aren't looking for work because, well, their support checks go on and their unemployment and their extra unemployment go on all the way to September. Now that ends in September, and so you'll probably see more people moving off the unemployment rolls onto the employment rolls. So these are the things to watch for as we go through the rest of the summer. Now, what does all this mean? What's the so what? Couple of things. We think the market's going to continue to have some volatility and bounce around through August. Probably a good idea to have some cash in our portfolios, so if we get some downturns in the market, we can take advantage of that and look for a few bargains. We think that that's kind of driven by this capital gains adjustment that we think, again, flows from March to August as people kind of are able to tax manage long-term capital gains here. We think that higher earnings are going to increase the quality of prices. And what we mean by that, as I've said before, as earnings go up, the price of the stock may not go up quite so much in the PE ratios, but the quality of that. So it brings basically a stronger price. And we think that's going to continue throughout the rest of the summer. Now, in terms of stimulus, well, stimulus is beating the virus. That's very clear. The first half, it was all about the government, and the second half is all about consumers. In 2021, it's stimulus versus virus, and we've seen how that's going to run. So stimulus is defeating the virus. In 2022, it's going to be stimulus versus taxes, that tug of war. The Fed wants inflation, so they're going to keep liquidity abundant, and we're going to continue to have that. And the economy's growing. Unemployment's falling, and U.S. market prices are going to be volatile as this quality improvement goes on, and the world is experiencing a multi-speed recovery. We're getting better in the United States faster than other parts of the globe. They're going to be coming on behind us, and so it's kind of like a do-over, right? So you can see the pattern of recovery in the United States being repeated in other countries and other parts of the globe. That creates a few opportunities if we want to look outside the U.S. for investment ideas. Now, certainly, you're welcome to forward this video onto your family and friends. We hope it's been instructive and of interest. Please visit our website and subscribe to our newsletters, blogs, videos, and other podcasts. I hope you found today of interest. Thank you very much for your time. Have a great summer. I'm Dryden Pence. Thank you very much.